It is quite possible we have already seen the high of the market for 2025. After what has been an historic rally off the April lows, there are early signs of weakness beneath the surface. Market breadth and other key metrics, which I'll review in a moment, are beginning to paint red. And on Tuesday, we just got a very scary sell signal. Today, I'm going to show you what that was and why it could be a sign that the stock market is topping. I'll also show you how I am positioning myself to profit from this potential pullback with a small 5% risk. Now, every bull market has a theme to it. This is really important both to identify what's going to be the big winners and also to know when the party has come to an end. In the late 90s, there was the dot-com stocks where Cisco, AOL, Microsoft, and other players ran thousands of percent. When those stocks began to roll over, of course, the party came tumbling down. From 2010 to 2020, the leading theme was big tech, where Facebook, Amazon, Netflix, and Google went on historic runs. After COVID, for the next 2 years, the theme was work from home. Our lives changed in a big way, and the big leading stocks were Zoom, Peloton, Teladoc, and other names that benefited from that. And it is no secret that over the last 3 years, the big theme of the market has been AI. Artificial intelligence. All the big winners from Nvidia to Supermicro have been in that space. Even through 2025, most of the big winners have been ancillary groups fueling the AI theme. So things like nuclear power, which is required to run these massive power-hungry data centers, and stocks like SMR and OKLO have ran several 100%. So knowing the theme of the market gets you in front of the winners, but it's also something to keep an eye on, because when these leaders begin to fall, they tend to bring the rest of the market down with it. And the big mega cap leading stocks of the AI rally have been Nvidia and Microsoft, AMD, Palantir, and they're starting to weaken. Now, I just started using a new brokerage platform, trying this thing out with no expectations. I'm surprised I actually like it a pretty good bit, and that is Moomoo. I know, not one I was expecting, but it's got some pretty impressive tools, and one of them really helps you stay on top of these leading groups. So this is the platform. Now, it's got all the usual stuff. You can see the big gainers, big losers, etc. for the day. But if you look up here at the investment themes heading, what it does is it compiles dozens and dozens of lists of stocks in certain areas. So more so than just tech or just mining, it's gene editing, it's solid state battery, it's China traffic. And what you can do is actually view these as charts and quickly see which areas of the market are outperforming, which ones are underperforming, and it will pull you the big names from that group. So let's just look at artificial intelligence, for example. Now, you can view all of this as stock charts. Let's see if I can make this go away. There we go. You can view all of it as stock charts. I like to look at it just as a list, and then what I do is I sort these by market cap, because obviously the bigger names are of more relevance and more important for the market. So you've got Nvidia, Microsoft, Google, Amazon, Broadcom, Taiwan Semi, everything in between. What you'll notice is a lot of red here, but this is an easy way to track a certain area, certain theme of the market. It's also a great way to pull a watch list from that. So if I wanted to look at, for example, nuclear stocks, okay, again, go back over here to my list of these. And there we see number 52, nuclear power. That's going to quickly bring up all the nuclear stocks. I can see what they've done for the day. I can also look at these as charts over the last 1 month or 3 months or year to date or short term. But it's a great way, in my opinion, to quickly get the pulse of a certain area. And so if you're looking for a broker interested in opening an account, I'll put a link down at the bottom of this video. I'll share this with you again. They have a really nice bonus going right now. So depending on how much you deposit, you get a bonus in the form of Nvidia stock. They also have this huge 8.1% yield on your cash for the first 90 days. It's better than you can get in any bank CD or any bond right now. So if you're just looking to make a little bit of extra free money on your deposit for the next couple of months, especially if after I show you this, you want to pull some out of stocks, click that link below. It'll take you to the page to open an account. It's free, doesn't cost you anything. I started this and put like 10 grand into the account. I'm trying it out. Really like it so far. Likely going to move some more money here going forward. We're starting to see some weakness, as I said, in those big leaders. And One of the biggest things I look for, this is both to identify a market bottom and a market top, is divergence. So divergence just means something is doing the exact opposite of what it should do. And so when markets are pulling back, when you're in a bear market, what you want to look for to signal the low is likely in is when the market goes up on bad news, right? All things being equal, bad news makes stocks go down, good news makes them go up. So if stocks or certain stock or index is so oversold that it's going up even on bad news, that is letting you know that all our sellers are out of the way, everything is fully priced in, and you really have nowhere to go but up. And if we look back through time, go back in 2020 when the market sold off huge from the COVID situation, right in here is when COVID was at the worst. This is when they announced they'd be shutting down the economy, businesses couldn't open, there's quarantine, all the big fears in the market, and that was the absolute low. And if you notice, in the middle of all this bad news, we had this day right in here, and I'll kind of try to I'll zoom in on this a little bit. But this single day, the NASDAQ index rose 7.7% in this sea of bad news, because this massive up day in the market. That was divergence. The market's going up on all this terrible news, and it ended up being low. In the 2022 bear market, which was fueled by above average inflation forcing the Fed to drastically raise interest rates and everything shot down right here in June. This is when we got the worst CPI report we'd seen in 40 years. Inflation, consumer price index inflation showed 9.1% year-over-year inflation. Worst we've seen since the 1980s. And yet, look what happened. Right as this awful news is coming out, the market begins rising, ran 10% in about a week and a half. That was a short-term low. It did come back and revisit this because news got a little bit worse, but for the most part, if you bought there in 2022, you'd be pretty darn happy you did. It was an early sign of divergence. And even if we go back to the trade war and the big sell-off and short-term bear market we had in March and April of this year, right here in this week, that's when the tariffs really heated up with China. Trump put, 150% tariffs on China. They didn't back down, slapped retaliatory tariffs on the U.S. It was the peak and the worst news. And then we got this day right here where the market rallied 12% in a single day. That is divergence, a big, big up day with bad news coming off the lows. And that, of course, was the low of the market. So on the top side, what we are looking for is just the opposite. We're looking for, hey, we got some good news and stocks sold off. And when you start to see that, it is often indicative of a high. And we just had a down day today, the culprit being the earnings report from Palantir. Now, Palantir has been one of the big leading AI stocks. Huge government contracts with the data giant. People are so bullish on this company. It can do no wrong. And Monday after the market, I've just got this breakout pattern here drawn. It's not really relevant to our discussion, but Monday after the market, they reported earnings, and the numbers were good. They beat earnings estimates by more than 25%. They beat revenue estimates. They raised their guidance as a triple beat. And when a big leading company in the leading group in a strong bull market reports breaking record numbers, the stock should go up. And it did for about 5 minutes. This is a 5-minute chart, and this was Monday afternoon. They reported earnings right after the market closed. They show all these good numbers, and the stock jumps, as it should. Jumped about 7% in the first 5 minutes, but then it reversed course. It sold off about 13% from that post-earnings peak, opened up Tuesday morning, tried to recover, and then teetered off to the end of the day. And so what we have here is a stock, a very important stock, that beat earnings yet came down about 8% on the day, and that brought everything down with it. You see, AI stocks are all interconnected in this web of what some people are calling circular trades. And what that means is a lot of the money is just kind of passing around between them. I'm going to do a separate video on this, but this is an image put together by Bloomberg showing the investment flows as well as the purchase of software and hardware and how the money flows around the big AI companies. So obviously, a lot of money comes into Nvidia to buy their chips. They're then investing a lot of that money or sending it right back to these companies for their services. You got companies like OpenAI investing venture capital dollars into firms where those dollars come right back to access their software. You've got Microsoft, which has been powering higher, not by record Microsoft Word sales, but because they own roughly a quarter of OpenAI, which many believe is going to IPO at a $1 trillion valuation. So they're all very, very much connected to one another. They're all dependent on one another. And so when one falters, the others tend to come down with it. And so if we look at what happened to Palantir today, we can see that about 8% drop as by the close. Well, it wasn't just Palantir. Nvidia came down about 4% as well. Microsoft, with its connection to OpenAI, is also selling off. And so these leading stocks are beginning to tell the story of money starting to flow out of them and thus out of the market. And the reason this is so vitally important, especially today, is that there is massive concentration in these indexes from the largest companies. I stole this image off somebody on Twitter, so whoever Guardian Trading is, I give you full credit for putting this together. But it shows the weight, how much of the NASDAQ index each stock represents. And if you see here, these 7 companies, Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, Alphabet, they are 63% of the NASDAQ index. Nvidia alone is 13.5%. And even in the S&P 500, which of course owns the 500 largest stocks, still even there, a small handful of companies represent roughly 40% of that index. So the other, whatever it is, 490 of them are just more than half. And so what happens is a stock like Palantir begins to show weakness. It's very much interdependent and vice versa on a company like Nvidia. Nvidia is going to bring down AMD and Microsoft and Intel along with it. All of that pulls down the NASDAQ because of their big weight. The NASDAQ selling off brings the S&P with it. That big index selling makes the other names go down because they're all pulled together. This triggers margin calls. Funds go risk off. They start dumping crypto and everything else. And so it's not this big panic situation where the market's going to melt down. There's just so much interconnectedness that essentially, as goes Nvidia, so goes the market. And considering how connected and dependent Nvidia is on the success, revenue, and sales of all the other companies, as soon as we begin seeing weakness there, that AI theme, the fuel that's been driving this market, that can run out, and that's going to take everything down with it. Now, I want to show you a couple of other things because, yes, these big AI tech stocks are the big weight, but we can look deeper and beneath the surface of the market and see how healthy things are. I've got a few tools to do that. One of them is this, which is the advanced decline line. So on top is the S&P 500 index. The bottom is the advanced decline line. It's just a reading of how many stocks went up or down that day, and it's continuous reading, so it adds to the previous number. And again, we want to look for divergences. This was the tariff war here in March and April that the market sold off. And look at the divergence there. Notice how the advanced decline line in yellow was making new highs long before the S&P 500 index was. That's showing you the market is much stronger than we realize, and it was foreshadowing what has been a record strong rally over the next 4 to 6 months. But then if we zoom in here, yes, the index is beginning to roll over a bit, but the advanced decline line is rolling over even faster. If we go back a couple of days, notice the S&P is basically right where it was on October 24th. Meanwhile, the advanced decline line is much lower. So it's very short term. This on itself would not scare me, but it's one more piece to this puzzle. The next thing I like to look at is the net new highs and lows, and that's the green and red bars in the middle. So it's similar to the advanced decline line, but what you're looking at is how many stocks made a new 52-week high today and how many made a new 52-week low. And I can show you here in the settings. It's looking at every stock on the NASDAQ, the New York Stock Exchange, the American Exchange, so all the big publicly traded stocks. And common sense would tell you that if you're in a strong, rising, healthy market, more stocks are making highs for the year than are making lows for the year. We've got an index that's 2-3% off the all-time highs. Yet we have all these, a couple hundred stocks making new lows for the year. And we would expect that in a bear market like we had here, February, March, April. But when things get healthy, you should see mostly more stocks making new highs than lows. And you'll get the occasional day. We're not going to abandon ship because one day there were more new lows than high. I mean, we get these little events, especially with Trump in office and everything going on. But we get one here, we had one here, then two, then another. And then we've seen 4 net new low days in a row. So again, the first time we've even seen 3 days in a row since the April bottom. Now it's 4 and counting. In addition, one thing I like to look at is the number of stocks above their 20, 50, and 200-day moving average. Now, 20 is pretty short term, but I use the 50-day moving average as sort of a proxy of what percentage of the market are in short to medium term uptrends. And the 200-day, what percentage of the market is in long-term uptrends. And I don't need to see this number rising forever. After all, it can only go to 100%, but it should be holding up. And if we look over here off the April lows, you see that we went from 6% of stocks in uptrends to 70% in about a month. That's huge. And it is held up here in the 60 to 70% range, but it is beginning to weaken. It's beginning to come down. And we've gone in just a week from 52% of stocks above their 50-day to only 39%. In the 200-day moving average, the green chart, we've gone from roughly 60% down to 52%. So it is showing weakness beneath the surface. And then finally, the last chart, this one's really starting to scare me, is the high yield index. So it's important to keep an eye on interest rates. Those obviously have a big effect on stock prices. But if you just look at the government bond yield, it's not painting the full picture. The high yield rate has a risk element to it. This is the rate that banks lend to companies that are not, AAA rated Fortune 500 that have more risk to them. And so they're going to be less prone to lend and demand a higher interest rate to do so. So, for example, I hate to keep harping on the same point, but the trade war, March and April here, suddenly there's a lot of uncertainty. They've got these monstrous tariffs, got retaliatory tariffs. Banks are scared. I don't blame them. They don't want to lend their money out. And so the rates they were lending went from 6.8 to 6.9 to 8.5% in just about a month. And when that happens, when the rate rises significantly, it tightens the flow of money. It's harder to get a loan. Less companies are borrowing and expanding and building, and the economy tends to shrink. On the other hand, when this yield is decreasing, companies tend to invest more and expand more, just like you and I do. We're much more likely to buy cars and houses and stuff when rates are at 2 or 3% than we are when they're at 8 and 9. And so this gives us a nice risk proxy of the interest rate market. And we got a little turn up here in early October, but it sold off. It came back down. The rate made new lows, but then just in the last week, we've gone from 6.4% to 6.77, so a 37 basis point jump. Now, interest rates have come up a little bit during that point, about 10 basis points, but this is a jump of 37 basis points. So when I put all these together, we've got a divergence event, a sell-off, and a post-market continuation of that sell-off in Palantir, one of the leading AI stocks, after a very strong earnings report. We have an advanced decline line that is rolling over and coming down faster than the index. We have, for the first time since the April rally, several days in a row of more stocks making new 52-week lows and 52-week highs. We have got declining percentages of stocks above their short, medium, and long-term trend lines. And we have a high yield or high interest effective yield rising at a pretty alarming rate. And when I put all those things together, it shows me the market is beginning to be weak. Now, every time I do one of these, somebody in the comments, here's Mr. Doom and Gloom. I'm not doom and gloom. Ask any of my viewers or members. I've been nothing but bullish on this market since April the 10th, saying we're going higher. Here's the areas you want to focus on. And we've seen phenomenal results from that. But my goal here is twofold. One, I always want to keep you guys abreast of what's going on in the market. I want you to know where the money is flowing, where the hot areas are, what the big stocks are, so you can make as much money as possible when conditions are good. On the other side of that coin, I feel a responsibility as someone who does this for a living to let you know when I see conditions are weakening. Because the fact of the matter is, there's going to be good times, there's going to be bad times. There's bull markets and bear. There are times when conditions just couldn't be any better, like they have been for basically the last 6 months. A rallying market, all those underlying fundamentals I showed you, we're painting bright green. We've got strong GDP growth. We got above average inflation. We got rate cuts. Everything is setting up to go higher. And now, for the first time, we are starting to see some signs of weakness. And I hope I'm wrong. I hope the market just pops up and rallies next week and rips to new highs. But if I'm taking a stab here and saying this might be the top, and I'm wrong and it runs higher, okay, I miss a 2.5% of the move. But if I'm right and the market does something like this over the next few weeks, you were going to be very happy if you had gotten out right up there. So here's what I am doing. I want to be short the market so that I make money if it comes down. This is both to profit, if my analysis is correct, and also offset any losses I take in my longer term positions. So what I've done is structure a trade to do just that, and to do it, I've used an ETF. Now, you can just sell something short. If you have a marginable account, you can do so. You pay the carrying cost of that short. But there's some simple ETFs. There's so many ETFs, in fact. There's inverse ones where you just buy the single stock ticker and you get short exposure. And for the NASDAQ, there's a single short NASDAQ. There's a double short. There's even a triple short. And I chose the double, which is QID. So QID is the ProShares Ultra Short QQQ. It gives you double short exposure to the NASDAQ. So all that means is, for every $1,000 you put into QID, you have essentially a $2,000 short position on the NASDAQ. So if the NASDAQ goes up 5%, you would lose 10. If it went down 10, you would make 20. So you don't have to get into short selling or put options. You just buy this simple ticker. Now, shorting can be risky on individual stocks. If they're going to come out and shoot up 50% overnight, you lose your shirt. Is the entire NASDAQ index going to shoot up 50% overnight? No. So if you're going to short something, this is the way to do it. And plus, again, we're only about 2% off the highs. If the NASDAQ index, the QQQ, goes up 2.5%, 3%, breaks out here, makes new highs, I was wrong. I'm happy to be wrong. I hope I'm wrong, and I'm willing to risk 2.5% to 3% to get it. With QID, I'm actually going to risk about 5%. So I bought it right in here at like $20. Obviously, this has been going down for the last several months because the NASDAQ has been going up. So if the NASDAQ then begins to fall, this will rise. So I bought it in here at like $20 a share. My stop loss, as you can see right here, at $19 a share. So I'm risking less than 5.5%. And if the market pulls back somewhere in the neighborhood of 5 to 10%, I should see somewhere in the 10 to 20% range for a profit. These trades are kind of interesting. It's one I actually hope does not work. But if the market does fail here, if we've made huge amounts of money on solar and nuclear and quantum and AI stocks in this big rally, and then we go in here and get short 2% off the top and then make money on the pullback, and then we let the market do what it usually does, where it comes in and it absorbs that selling and it compresses and consolidates and then breaks out higher, and we get back into stocks in here, that's about as good as you can possibly do it. And so that's what I think could play out here. Now, just to be clear, I am not calling for a big, massive bear market. I don't think the sky is falling. I don't think the index is going down 50% in a month. Honestly, I think we're probably due somewhere in the 8 to 12% pullback range in the market. Why not more? There's no real catalyst to drive it down. In 2022, we had interest rates going from 3% to 8%. In 2020, they shut down the entire economy. We had a nation or global-wide pandemic. In 2025, Trump declared a trade war on the entire world. Those are big macro factors. In 2008, we had this massive housing crisis and huge default. defaults. There is no major catalyst here. There is no fundamental reason the market should crash now, but I'm just looking at the technical signs that tell me we're a little bit overcooked, so I'm pulling back on the long side. I'm putting in a small short trade now. I only got a little bit in this account. Like I said, I just opened this Moomoo account. The other cool thing is it links to TradingView, and there's no better experience than just having your charts on TradingView, because I'm just addicted to them now, and also the trading. So I just put 10 grand in here. So I bought 500 shares of QID. You can see it's up just barely anything right now, and I've got to stop on this beneath the lows at about $19. So if you guys are looking, I get a lot of questions about what's the best one to use. I have never recommended, I never really used Moomoo before. I wasn't expecting much, but I am really impressed with it. So if you're interested, I'll put a link down below this video. The other cool thing, brokerages tend to do little bonuses here and there. It's part of their marketing budget. Sometimes, hey, open an account, we'll give you a $250 bonus. Sometimes it's this. What Moomoo's got going on right now is both a cash bonus for deposits, and they're doing this in the form of fractional Nvidia stock, plus an 8.1% yield for the first 90 days on your cash. So if after watching this, you thought, I don't necessarily want to go short, I want to get out of the market, but I'd like to earn something, well, just stick it in cash here. It's 3.6%, but you're getting an extra 4.5% for the first 3 months. So for those 3 months, you're earning an annual rate of 8% on your money. Doesn't cost anything to open an account. So I'll put a link below if y'all are interested. It'll take you right to that special bonus they've got. Again, it links to TradingView. I really like it so far. I'm probably going to move some more money over, but I'm going to keep playing with it. And if I find other cool stuff, I'll share that with you. But this, in a nutshell, is what I'm seeing. Whether I'm right or wrong, I encourage you to take these little nuggets and save them for later. When you do get the next bear market, look for those times when you see stocks spike on apparently bad news. When you are in a big rally, look for stocks selling off on apparent good news. Those are really good telltale divergence signs that you could be at one of the extremes. And if you haven't already, hit the subscribe button down there in the corner. That way these videos will show up in your feed and you won't miss another important update.